Today we're going to talk about successfully managing your student loans. The agenda: financial aid landscape, loan servicers, loan basics, repayment plans. It's going to be a big one. Postponing repayment, deferments and forbearance, delinquency, default, and collection, and a little bit about discharge, forgiveness, and cancellation. I'll be going over the slides quickly, and if you need to visit more in-depthly about the slides, please visit with your instructor, Amanda. The financial aid landscape. What are the sources of financial aid? Well, they come from federal, state, and local sources like colleges and universities, as well as private foundations. Here at Des Moines Area Community College, our scholarship office is known as the Foundation, and offer scholarships to our students on a variety of amounts and programs and criteria. And the basic or minimum qualification is that you have to have a 2-point grade point average to qualify. My office will send notifications as scholarship deadlines approach, encouraging students who meet the minimum qualifications to apply for the DMAC scholarships. They range sometimes from $500 to $1,000 per semester. Private companies and employees, we have a listing on our website as well. If you're interested in finding out what community resources are out there for scholarships from private companies as well as professional and service organizations. What type of financial aid have you received and could receive at DMAC? Covers all gamuts. Grants, which are federal Pell Grants, federal Supplemental Education Opportunity Grants, grants from the Iowa College Student Aid Commission in the form of Iowa Tech grants to help you if you are a career-oriented student in a major that's leading to a career in a voc tech area or a work shortage area. Work study is a federal work study program that the college administers, and currently we have about 400 students who are employed district-wide in departments around campus, and we pay minimum wage, $8.25 an hour, and that may go up after May 1st. And scholarships, again, scholarships internal and external. Internal, the foundation; external, community organization, agencies, and donors. Merit awards. We have an honors program scholarship that we award to students who have been admitted to the honors program based upon their ability, high grade point average, etc. And of course, there are student loans, both subsidized and unsubsidized federal direct loans, and the parent loan or Parent Plus. And a grant, again, is free money that does not have to be repaid, whereas loans you will need to repay, particularly if you receive one while you're a student, if you cease to be at least a half-time student. Your financial aid history, gift aid versus self-help. Self-help, again, is work study and loans. Gift aid, Pell Grants, scholarships, money that does not have to be repaid. Federal student loans versus private student loans. The federal government wants all schools to encourage students, if they will take out a loan or must take out a loan, that they borrow federal student loans first. Interest rates on those loans are low, 3.86% currently, and private loans, it could vary. Know your balance. How many of you know what your student debt is? We can help you with that on our website. In financial aid, we link to the Department of Education, and it can list your loans that you have, or you could be directed to the direct loan website. There's an agency called the National Student Loan Data System, NSLDS, that houses all of the financial aid records nationally. It stores information not only about our students, federal grant and loans, but every other school that's eligible to disperse student financial aid. You'll be able to check your amounts that you've borrowed for federal grants or loans by visiting the NSLDS website that's listed here, but you must have your DMAC PIN, which is your personal identification number. Excuse me, let me make a correction. Not your DMAC PIN, but your Department of Education PIN or your Federal Student Aid PIN. Now, I may have done that to see if you were listening, and if not, now you know. Federal Student Aid PIN, not your DMAC PIN, will gain you access to the NSLDS site. Your loan servicer. Your loan servicer is the agency that is going to contact you or keep up with you, if you will, your paperwork, your loan repayment histories, etc., once the school disperses the information to you. If you have any customer service issues, they will be happy to work with you. In other words, they perform all of the administrative tasks associated with your maintaining your loan on behalf of the lender, which is, of course, the United States Department of Education. This will look familiar to you if you go in and retrieve your loan information. Again, you will need to make sure you have your federal student aid PIN, which is the same PIN that you use when you completed the free application for federal student aid. This is a picture of what the loan site looks like. You would need your social security number, the first 2 letters of your last name, your date of birth, and of course your PIN. Loan basics. Here at Des Moines Area Community College, you probably won't hear us talk about the Federal Family Education Loan Program. It ended in June 30th, 2010, but we were, and have been, and still is, a direct loan lending institution, and most of our loans, if not all, in the last 7, 8, maybe even further, 10 years, have come from the Federal Direct Loan Program. And we do not offer Perkins loans here. I wanted to make sure these sites were available to you because you may have transferred from an institution that you once received a Perkins loan, or you were on the old FELP program. But loans that we make to our students are all federal direct student loans. Current federal student loan types, again, direct subsidized loans, direct unsubsidized loans, direct plus loans for parents, are the loans that we provide here. Perkins, we do not. Direct plus loans for grad or professional students, we do not. And direct consolidated loans are loans, if you want to consolidate your direct sub or unsub, you can, but that will not be done at the college level. And if you're interested in interest and how it's calculated, it's calculated on a simple daily interest rate. And they give an example here, if $10,000 at the interest rate of 3.86%. Another example of how the payments are applied, given an example of using $10,000. Let's talk about repayment plans. There are several. Traditional plans, 10-year standard, extended graduated, extended graduated, consolidated standard, consolidated graduate, income driven, income based, income contingent, and pay as you earn. And remember, we are a DL school, direct lending. The standard plan is the plan that most students are under. Under this plan, the borrower will pay a fixed amount that ensures that they pay their loans in full within the repayment period, and the payments must be at least $50 per month. For the subsidized, meaning that the interest on the loan is subsidized while the student is in school, at least half time, and unsubsidized, the interest will accrue while the student is still attending. And of course, plus loans the same. The repayment period is 10 years. And consolidation, if I may take a moment to explain, when you're talking about, or when we're talking about consolidating, we're putting more than one loan together. You could be an unsub or subsidized, and the Department of Education will then use a weighted interest rate to determine what the monthly payment will be. For borrowers, again, who do not have a consolidated loan, this plan is the lowest total interest paid. Extended, under this one, as the slide points out, the borrower would pay a fixed or graduated amount in an amount that will ensure that they pay their loans in full within 25 years. A borrower who chooses this plan, if he or she did not have an outstanding balance on a direct loan or FFELP as of October 7, 1988, and he or she has more than $30,000 in an outstanding direct loan. But again, I want you to pay particular attention to how long the repayment period is, because the longer the repayment period in terms of paying the loan in full will also probably have you pay more interest. Graduated payment. Under this plan for subsidized, unsub, and parent loans, the repayment period could extend is 10 years, but for consolidated loans, it could go as between 10 to 30 years, depending upon the total education indebtedness. The minimum payment will always equal the amount of interest that accrues monthly. Consolidation. As I said earlier, and here's an example, the interest rate is weighted against the consolidated loans, or it's the weighted average of the loans that one would have. Say direct sub and direct loan unsub can be consolidated, and there's no interest rate cap. Additional information about loan consolidation: one lender, one monthly payment. That's the benefit of consolidation. You're not making payments to two different lenders. Flexible repayment options, reduced monthly payments, fixed interest rate, which is weighted now. And note that private loans are ineligible for federal loan consolidation, but can be used to establish the repayment period on the consolidation loans. Again, the repayment period for consolidated loans is based on total educational indebtedness, and this will include federal student loans that you can consolidate, federal student loans that you do not consolidate, and of course private student loans that you cannot consolidate. And the example here, if your total education loan indebtedness is $7,500 but less than $10,000, your repayment period will be 12 years. $60,000, 30 years. Income driven, pay as you can. This is an interesting one. The pay as you can earn repayment plan helps keep your monthly student loan payments affordable. It's going to be the lowest monthly payment of them all, and usually has the lowest payment amount based on your income. Payments are generally 15% of your discretionary income. There are some advantages, of course, and there are disadvantages. A few of the advantages: pay-as-you-earn payments count for public service loan forgiveness that we'll talk about a little bit later, and any remaining principal and interest will be forgiven after 20 years of qualifying repayment. But again, I want to caution, as you're looking at the options, some will be more attractive than others initially, but over time, interest will accrue. Disadvantages: again, I can't stress it enough, more interest paid over the life of the loan and the others. The income contingent repayment. For direct loans, only that bases a borrower's monthly payment on discretionary income and loan amount. Payments are the lesser of 20% of discretionary income, and they are the advantages and disadvantages here as well. Again, a disadvantage: more interest paid over the life of the loan. And one advantage, of course, is any remaining principal and interest will be forgiven after 25 years of qualifying repayment. Next, we're going to discuss the income-driven, income-based repayment plan. This plan is designed to reduce monthly payments to assist in making your student loan debt more manageable. Again, these are 15% of discretionary income. There are advantages and there are disadvantages. I know by now you're saying, I know what the disadvantage is. You're right, more interest paid over the life of the loan. But there are a few advantages too. And one of them is that the government will pay the unpaid interest on subsidized loans for up to 3 consecutive years if the monthly payment does not cover the monthly accrued interest. And the others, as you can see, deal with the limitation on capitalized interest, and the other on any remaining principal and interest. It will be forgiven after 25 years of qualifying repayment. And the IBR payments count for public service loan forgiveness. So as you can see, there are advantages, but if you're conscious over time about the amount of interest paid, then look at this loan very carefully. And also, you may be at different points in your employment career where some of these loan options may be more attractive early on, but you may not want to stay with them for the duration of the entire repayment period. And we'll talk about the public service loan forgiveness in another slide. Repayment plan summary. I give a wonderful example that puts all of these plans sort of together for us. Billy borrower, $35,000 in student loan debt with an interest rate of 3.8%. And oftentimes you'll have a fixed rate that you go into with the first loan that you have that you will keep. So if you go on to a 4-year school or grad school and you're still borrowing unsubsidized or subsidized loans, it will have the same rate. This case for Billy is $35,000. He gets out of school, he earns $30,000. He is single and he lives in Indiana. We should have changed that to Iowa. Go Iowa. His income increases at a rate of 5% per year. As you can see from the chart, it's very easy to look at. 10-year standard, okay, $352 a month. Final payment didn't go up much at all. Total paid interest, $72.44. 10 years. Let's go down to pay as you earn. $106. Initial payment, final payment $352. Total time and repayment 20 years. Total paid interest $20,000 plus. And for those folk who use the consolidated loans, say if Billy consolidated all of his federal student loans, the standard repayment plan and the graduated repayment plan will have an extended repayment period. Remember, they were 10. Now, if he consolidated, it could go as high as 20. But what happens? Consolidated graduate, the final payment is lower at first. Total paid, $54,000 and $50,000. Interest, a lot more interest. Student loan, if you want to pay as you earn, the other options, you can go to this very familiar site. If you are currently a student loan borrower, you've been here. This is a site where you log in using your Department of Education PIN or federal PIN, and you can do your entrance counseling where all of this information is told to you, and you can sign your master promissory note. That master promissory note is good for 10 years. If you had a loan, say 5 years ago, 4 years ago, 3 years ago, you've been out of school, you probably will have to do a new master promissory note, but they are good for 10 years. So that's why they call it master. You do one note. But for entrance counseling, you may have to do at each new school you attend. We have students who had a loan at another institution. Last year they come to DMAC. Even though they may have borrowed before, we still have the student go through the entrance counseling because, as you can see, there's a lot of information. And of course, you'll need the social number and the date of birth to sign in. If you want to estimate your loan payments, this is a site where you could do that as well, studentloans.gov. But we've made it convenient for you. We want you to use the web infosys log on to the financial aid menu, and you'll have an array of, from looking at your award, looking at your cost of attendance, calculating your academic progress is there for you. Not even calculating it. If you've been with us more than one semester, it'll be posted for you. And we also have a debt management tool that you will find helpful, and it will link to several of the U.S. Department of Education's estimators. You can see you can do various things once you get into the studentloans.gov. You can look at your entrance, master, direct, and also the payment plans that we mentioned. Postponing repayment, deferment, and forbearance. Deferment. If you're having, once you graduate from school or you stop being at least a half-time student and you can't pay your loans back after the grace period expires, deferment. Unemployment, economic hardship, graduate fellowship that doesn't apply to us, rehabilitation, military, and school deferment. There's a lot of in-school deferment. That's the one I was talking to some other groups about earlier today. And if you're continuing on, it's been a small break between terms, each school should have a deferment form you can complete that will be sent to this National Student Loan data system where all this information is housed, so they know that you're in school and not to penalize you, if you will, for not paying on your loans. But unemployment, economic, hey, it's tough out there. And these forms will keep your loan from going into default. And a loan that has not been deferred or have not gone through forbearance, meaning that, simply put, forbearance is that you're willing but you're unable to. If you have, these reasons can help you to stave off having to make a student loan payment. The medical, student loan debt burden, all of the teacher loan forgiveness once if you're in a 4-year school and you're moving on. And of course, last but not least is the medical and any other acceptable reasons. And these forms are listed on the website that you can download and submit. Again, keep in mind that deferment and forbearance postpone making payments. Deferments have eligibility criteria. Some forbearances have eligibility. Others are at the lender's discretion. You have to work with your servicer, and the servicer for your loan is stated in the student loan. If you don't know, you can go to studentloan.gov or NSL student, the student side of the NSLDS, which is the National Data Student Loan Systems, and find out. And there are time limits. Unpaid interest capitalizes at the end. So if I was a finance advisor, I would say be very careful of the deferments because the interest is continuing. Delinquency default. Here to remember, default occurs after 270 days of delinquency. And there's various stages of delinquency after the grace period. There's early, mid, and late. Late stage, we want to make sure you don't get there. So if your loan defaults, it could have consequences on you not being able to continue your education if you haven't finished it, and the school who lent you the money or processed your paperwork. If too many students default and the default rate goes up, then that could put sanctions on that institution. So we're very mindful and would like for any student who is in late stage delinquency, 180 days, you're getting really close to that 270, to really, really make sure that you talk to the school or your servicer. And the loan servicers probably would have been trying to contact you before you get to 270. One of those phone calls right after supper every evening. Don't let that happen to you. Consequences of default reported to credit bureaus. Can't tell you how often we get a phone call from an irate student who's just beyond him or herself because they didn't remember or forgot. Now they're in the real world, and maybe both partners, spouse, whomever, they're married or want to move in together or what have you, want to buy a first home, and now because of late payments or defaulting, it's on the credit report, and it could hamper them from purchasing that first home or the car that you would need to get to and from work. So it's important. No more eligibility for financial aid for default. Loan immediately due and payable in full. Lose eligibility for repayment plans and deferments. Collections people calling you, and you don't want the administrative wage garnishment or your tax return from your hard work being garnished because of this. So the easy thing to do, fill out one of those deferment or forbearance forms and not get yourself into one of these situations. Getting out of default, repay loan in full, that may be difficult to do. But consolidate and agree to repay on the income-driven plan, it's a possibility. Rehabilitate the loan, make 9 on-time payments in 10 consecutive months. We've told students to do that many times. Consolidate after making 3 consecutive payments. Probably a good option or a better option. Discharge, forgiveness, and cancellation. Of course, if one dies, the loan is forgiven, canceled. Disability, public service. And like I said, I was coming back to that. If you do certain public service or if you're teaching. Public service loan forgiveness. Now we can talk more in depthly about it. 120 qualifying payments on direct loans, on qualifying repayment plans, and it's going to talk up here a little bit about while working full-time with a qualifying employer. The borrower must always be employed, and I'm sorry for reading this to you, but it's so important. The borrower must always be employed by a qualifying organization at the time that the borrower applies for and receives the public service loan forgiveness. According to the Internal Revenue Service, the forgiven amount is not treated as taxable income. And for more information about this, again, at that wonderful website, studentaid.gov/public service. Qualifying payments, as stated here, make 120 separate monthly payments and 15 days of the due date. It's pretty straightforward. A borrower would not receive credit for more than one payment toward the public service loan forgiveness. Exceptions are AmeriCorps and Peace Corps, or borrowers who make lump sum payments using education award or transition payment. These plans qualify, as you saw through the earlier slides, when it was mentioned that the 10-year standard, of course, is one that most students use, but the graduated extended ones aren't. Qualifying employment, you probably were saying, does my job qualify? So now we're here a little bit. Any government organization, doesn't matter what the borrower's job duties are. 501c, not-for-profit organizations. Other not-for-profit organizations providing specific qualifying services. And the website that I instructed you to go to will get into more detail. This is a reminder for you to utilize a studentaid.gov resource, because here you'll find information on not just repaying your loans, as you can see, but preparing for college. Maybe there's someone you can assist who hasn't reached college yet, types of aid, who gets it, and applying for financial aid. So again, a very helpful resource, not just for students, but for staff as well. Repay your loans. This is a screen that shows you how to download that information to look at repayment calculators and learn more about understanding repayment, loan consolidation, deferment and forbearance, forgiveness, cancellation, and discharge. The good part about all of this, folks, is that this site is developed and maintained by the U.S. Department of Education. So everything on here is current, and it's what the department wants students and professionals to know. Questions, if there is anything that you need, you can call the hotline to get help on completing the FAFSA, information about the process, awarding, etc. And just remember 1-800-4-FED-AID.